The Fed just told you in very polite central banker language that your mortgage, your credit card, and probably your job are staying in the danger zone longer than you thought. They held interest rates high again. No cut, no relief. And underneath all the calm wording, there's one message. We do not trust this economy yet. If you're wondering, does this mean my house price drops? My stocks crash? My boss freezes hiring while AI takes my job? That's exactly what we're breaking down. By the end of this video, you'll know 3 things: why the Fed is refusing to cut, what that means for your debt, savings, and investments, and what signals to watch so you're not blindsided when this finally breaks. Let's get into it. The Fed's official story is simple. The economy is still solid, unemployment is stable, but inflation is still too high. So they left rates where they are. Translation into normal language. The patient is walking but still sick, and the doctor is scared to stop the medicine. They dropped rates a bit over the last few meetings, but now they've hit pause. That pause means they're afraid that cutting too fast will send inflation right back up. And they really don't want to repeat the 1970s. Cut early, declare victory, then watch prices spike again. Here's where things get interesting. Because while they talk about maximum employment and stable prices, they're actually fighting 3 different fires at once. Sticky inflation, wage pressure, and an economy that's slowing just enough to make everyone nervous, but not enough to justify panic cuts. Inflation has come down from the peak, but it's still above their 2% target. And the parts that are left are the hardest kind to fix: rent, services, healthcare. You can't crush those just by raising rates for a few months. That's why they're holding them higher for longer. On the job side, official unemployment looks okay, but job gains are weaker. Companies are getting cautious. Instead of mass layoffs everywhere, we're seeing the quiet stuff. Hiring freezes, fewer postings, more contract work, and a lot of "we're not backfilling that role." And all of this is happening while AI and automation are rolling in like a slow tsunami. Employers see tools that can replace some jobs. And surprise, they're not in a hurry to hire humans on permanent salaries. But it's even getting worse, because high interest rates make that dynamic sharper. Strong companies with cash can invest in AI and automation. Weaker companies choke on higher borrowing costs and just cut people. So what are the key takeaways from this Fed decision? First, no cut is not a surprise. Markets expected it. The surprise is the tone. They're clearly not in a rush to go back to free money forever. The era of near-zero interest rates that made everything a bubble, that's probably gone for a while. Second, the Fed is terrified of being blamed for inflation again. They got roasted when prices exploded, and now they'd rather risk a slower economy than admit they cut too early. Third, they keep repeating that they're data-dependent. In practice, that means they'll wait to see more clear proof that inflation is dead before making big moves. Think months of cooler inflation data, not one good report. And here's where things take a step further. Because for normal people, data-dependent means chaos-dependent. Your mortgage, rent, and job security are now tied to every monthly inflation print, every jobs report, every corporate earnings call where a CEO says cost-cutting or AI productivity gains. Let's break down what this actually means for you. If you have debt, credit cards, car loans, variable mortgage, high rates hurt. Your payments stay heavy. This is exactly what the Fed wants. Less spending, less borrowing, slower economy, weaker price pressure. But for savers, this is the first semi-decent environment in years. High-yield savings, CDs, treasury bills, they finally pay something. It's not exciting, but it's not the 0.01% joke we had for a decade. But then the unbelievable thing happened. In all of this, a quiet shift. The winners are people who can wait. The losers are people forced to roll over expensive debt or gamble just to keep up. When I was about 12, my parents lost most of their savings after trusting a bank advisor who was basically selling whatever the bank wanted to push. No screaming, no drama, just a very quiet dinner table for months. That's when I learned, when experts screw up, normal people eat the bill. That's the same energy I see here. The Fed kept rates near zero for years, helped inflate insane bubbles, and now they're slamming them high to clean up the mess. Regular people are stuck in the middle. So what should you actually watch next? First, inflation data, not just the headlines. Look at core inflation, especially services and shelter. If rent and services stay hot, the Fed stays tough. If they cool off for several months in a row, rate cuts become more likely. Second, the job market. Pay attention to job openings and layoff announcements, especially in sectors getting hit by AI and cost cutting. If unemployment suddenly jumps, the Fed will feel real pressure to cut, inflation or not. But then he said this unbelievable thing. Because every time the Fed chair does a press conference, the market doesn't just listen to what he says, it dissects every word, one slightly different adjective about the economy, and Wall Street trades like it's a new religion. That's where the game gets twisted. Politicians want growth before elections. Wall Street wants cuts to pump asset prices. The Fed wants to not look incompetent. And you just want to know if your rent, groceries, and 401k are going to survive. Meanwhile, AI is sitting in the background like, hey, I can cut your labor costs by 20% if you're willing to fire some people. Corporate boards hear that very clearly. Quick side note. This video was built using the same AI system that powers this entire channel. It's called Fludge.io. If you're watching this thinking, I want a channel like this, but I'm not going on camera and I'm not spending 10 hours a week researching, that's literally what it's for. It finds topics, writes scripts, makes the video with an AI avatar, and posts it. You review, tweak, and hit publish. It's not magic. It's just removing friction. If that sounds interesting, check out Fludge.io after this. Back to what matters. What do you do in a high-rate, AI-heavy, slow-growth world? In my early 30s, I put money into something boring while everyone else chased hype. It didn't make me rich overnight. It just worked. Slowly. That's why I'm allergic to anything sold as a once-in-a-lifetime opportunity, especially in environments like this. High rates punish speculation. Expensive money kills nonsense faster. Meme coins, junk IPOs, profitless tech with a good story. They all struggle when borrowing is painful, and investors can get 4 to 5% in something safe. Here's where things get interesting. So if you're investing, this environment quietly rewards 3 things: patience, cash flow, and risk management. I'm not telling you what to buy. I'm not your advisor. But I am saying, this is not the time to gamble your rent money on the latest AI stock because some guy on X posted a rocket emoji. For your day-to-day life, if you've got high-interest debt, the Fed just told you it's not going away soon. Prioritize killing the ugliest debt first. If you're a renter or thinking of buying, understand that high rates can pressure home prices, but they also keep monthly payments high. There's no free lunch here. For your job, assume your company is thinking about AI, even if they pretend they're not. Upskill. Get closer to the parts of the business that make money, not just the parts that can be automated. Let me wrap this up simply. The Fed holding rates high means slower economy by design, pain for borrowers, a bit of reward for savers, and a very weird, uneven job market where AI and policy decisions collide. They're trying to fix yesterday's inflation without breaking tomorrow's economy. History says they usually overshoot one way or the other. Your job is to not let their course correction wreck your finances. Disclaimer: nothing in this video is financial advice. It's for information and entertainment only. Do your own research and talk to a licensed professional before making money decisions. Now I want to hear from you. Do you think the Fed is doing the right thing by keeping rates this high, or are they about to break something big? Drop your take in the comments. If you found this breakdown useful, hit like, subscribe to the comment section with Thomas Paul, and share this with someone who keeps asking, so, are rates finally coming down? I'll see you in the next one.